This is my first consultation call I've ever had with Trade Brigade. This is part 3 of my new series I am making, and today we're going to learn about the concepts of 3-bar plays and how Trade Brigade uses his strategy to gain knowledge about the psychology of other market participants when using a candlestick chart. You see, on a candlestick chart, you see the green and the red candles, but based on certain patterns and the way candles move, those can give you key indications as to what other time frame participants are thinking about in the market from both the retail and the institutional traders. And the better you know what other traders are thinking, the higher the chance you have of taking advantage of good, high probable, successful setups that go along in your favor with your strategy. I personally have increased my knowledge on how to gauge the psychology of other market participants, definitely with candlestick charts, just as Trippier has mentioned. There's going to be many more we go over, but specifically for this video, we're talking about 3-bar plays and how he uses candlestick charts and what time frames he looks at to gauge the psychology of other market participants. And again, this is after 2 years of learning what Trade Brigade has taught me. And as of now, building upon these building blocks, starting from the ground zero to now, I'm currently at 5 profitable months in a row. So again, and they're decent withdrawals in the few, anywhere from about $400 to $500, $600 of withdrawal. So with that being said, guys, don't forget to like and subscribe to Day Trade Knockout. I look forward to seeing you on the video. Stay safe, Green. Good luck to all my fellow millionaire traders. Peace out.
Okay. Now, just curious question, because I kind of got a gist of that, but again, honestly, this isn't all gibberish to me. Like when you were mentioning the whole hammer candle, inverted hammer, the inverted doji, like I understand all that. Now, 3-bar play, that is the first time I ever heard that term, for example. Like, is there any videos you have on your channel or places or courses I can take that specifically talk more about that besides your trade boot camp course? Because I already watched that and took it.
Yeah.
Is there any other, like, videos I can watch to advance that?
There's definitely some good articles out there. I don't have anything on my channel, and I don't have any, course material that kind of covers that, but if you just search up 3-bar play, I'm sure there'll be plenty of articles that show up that can sort of speak to the thought process there. But
okay,
the idea is basically, right, it's big momentum shows up, and then this really represents just a pause. And so that momentum's holding, right? And ideally, these setups respect the 50% mark of the momentum bar. So bar number 1, you really want to see the inside bar above the 50% mark.
Okay.
In terms of retracement.
Would you chart a fib right there?
You could. I just, generally, I just look at it visually and say, it's roughly, it doesn't have to be exact. You know what I mean?
Okay.
You don't have to bust out the Fibonacci and say, oh, we're 1 cent underneath the 50% mark. It's no longer valid. It's not so precise. The thinking is just that generally you want to see a bit of a pause and consolidation here before making the next move. Because if you think about what's going on here, remember that trading is all fractal. The time frames, they could go down infinite amount of times until you get to basically tick charts like what you were looking at. And you're looking at every single trade, like a 1-tick chart. Be kind of unreasonable to look at, but you could do it technically.
Yeah.
So think about this. Like if you saw this, actually we've just got an example that's fractal on our screens, right? So if I zoom in on the hourly, this is a 3-bar play. This is bar number 1, the green bar, that's giving us momentum. Number 2 is this little consolidation in the upper 50% of that green bar. If we think about what this is, right? All this is a smaller time frame bull flag. Right? So here it is on the 5-minute.
Okay.
Right? So it's representing a solid push and then consolidation. And then when you see it on like a higher time frame, it's just easy to see, oh, it's a 3-bar play. And the thinking is just that, okay, on some smaller time frame, it's a flag. So if you see a 3-bar play on a 5-minute chart, it's probably like a 1-minute bull flag.
Okay. Yeah, I understand. I get that. Yeah.
Got it? Yeah. So that's kind of that's how this pattern sort of sets up. You're just leveraging a higher time frame to simplify the pattern of a smaller time frame, reducing the noise. And then you're just looking for an excuse to play it in the upward direction, aka a break of these highs. Or a pullback that offers up a hammer candle, right?
Mm-hmm.
That way we can go long over the high. So I'll put E here for entry. I'll put SL down here for stop loss. And then we've got some target based on the hourly structure, which we know is this 40-50 zone from retracing the thin structure over here,
Mm-hmm.
right? So our job is as simple as saying, okay, we just need to find, we know that the daily trend, it's definitely down here, but we know that we just made a lower low.
Mm-hmm.
On the hourly chart, we've established a bottom, right? The context of this level in here.
Yeah.
So we could look for some sort of lower high bounce,
Mm-hmm.
counter trend, CT, counter trend type move.
Mm-hmm.
So longs are kind of on the table. Now, if we take it to the 5-minute chart, we know that the sellers failed underneath the low of the morning, and there's a gap underneath us. So the lack of gap fill is not bearish whatsoever. Like, that's very bullish, the fact that we got such a strong reversal off of a partial gap fill.
Mm-hmm.
And then we get the 3-bar play. So to me, like, just walking through the steps of the story of what was unfolding here
Mm-hmm.
is, this could use a counter trend move. This could use a counter trend move now that we've found a bottom. This is looking bullish with a failure from the sellers, right? Because don't forget, something that's often overlooked is that the failure from one side of the trade is oftentimes just as important, if not more important, than the side that's ultimately going to get the rally, right? You could have said early on that, like, oh, momentum faded out early, and, like, the buyers didn't really have anything going on here. But
Mm-hmm.
in the context of the morning, right, we're still above the opening print. There's no gap fill going on. The sellers really, like, although the buyers, they didn't just make a straight line in the upward direction until the more meaningful pullback happened. It's really not that the buyers were not failing whatsoever on the morning. It
No.
was the sellers.
Mm-hmm.
The sellers were the ones who were not doing anything impressive. And really the evidence for that was this right here.
Yeah,
Um,
double bottom or what?
Yeah, you could look at it as a double bottom, but just, think of it from a psychology perspective, right? This to me, my entire edge in the market is really understanding the psychology of the people trading the market. So think about it like this. On the open, you get inverted hammers here, you get a gap up, you get people who are skeptical because, if you ask anyone who's a fundamental trader, right, they'll tell you that the market belongs at like 2,500 or whatever. So they see the gap up as a gift to short at higher prices. They think that the market's going to fade back down, whatever. You get some participants who try to short here. You get some participants who nail the top and short here, which is great. You kind of got involved somewhere in here. And
Yeah.
then this is the biggest trap of them all. This is the biggest trap of them all. Technically, we break the low of day and we start to move into the gap. So like any reasonable trader could have seen like, oh, okay, so we've got a gap underneath us. We've kind of failed to hold up at these highs. We're at that point, we're just trading around kind of in here, right? Still inside of this as a range. Maybe we're rejecting the top of the range, right? So this move, the wick underneath, is a great place for shorts to get trapped.
Okay.
So on the break of low of day, you have to imagine that shorts who have a strategy that says, when we break low of day, I go short, right? There are people who have strategies like this. It's a thing.
Mm-hmm.
So shorts pile in here, and then what do they get? They get an absolutely face-ripping rally in the
Mm-hmm.
opposite direction over the span of 5 minutes. It's not like it was a slow grind out of this. It was like instantaneously, nope, wrong. Short is not the idea here, right? So
Yeah.
that tells us something.
Yeah.
So if like now just like getting in the heads of these shorts, if you're short here,
Uh-huh.
if you're short here and you've got to stop over the high of day, this
Uh-huh.
candle is definitely making you nervous. You're like, oh
Uh-huh.
my God, that's terrible. So as soon as we take this out, now,
Mm-hmm.
like as soon as high of day is now taken here, you've got to think that there is no such thing as a short trader in this market.
Mm-hmm.
And if there are no
Okay.
shorts, then the next obvious move would be,
Go
waiting for
long.
some sort of long setup.
Uh-huh.
Right? And based on the fact that we know that this can afford a counter trend, this found a bottom, is seeing momentum, right? We gapped up. Like, let's not forget also, whenever we gap on a day, instantly the context for that day is in the direction of the gap. So in the case of a gap up, the context is always bullish right out of the gates. Sure, we look for the fade to close the gap, but remember, in my pre-market streams, you hear me say this all the time. We're always looking for the gap to fill and then a reversal, right? Because the context of the day is immediately in the direction of the gap. In this case, bullish. We've automatically made on an hourly chart a new higher high. So the gap fill represents finding a higher low, and then the reversal out of it is to try to make that equal high, which is always why we look for the opening print.
Okay.
Right? So structurally, that's why this makes sense. Psychologically, that's why the sellers did not, or that's why the sellers didn't reshort up here at the highs, is because they just got, screwed on this move here. So as soon as this flag consolidation 3-bar play on the hourly chart gets put in, I wouldn't, let's be clear, I wouldn't really be thinking about longs as we're breaking the high of day here. I'm kind of thinking about longs as we start to get this consolidation at the highs, right? Because the other thing that could, of course, happen, we could have done something like this. So in that instance, you chalk that up to a really choppy day, and it's like, whoa, not interested in that. But the fact that this consolidation holds above the morning high strikes me as bullish. And once again, we're just looking for any kind of excuse to go long. So I see two kind of areas that make sense to go long on this chart. And that would have been as the consolidation is taking place with this long wicked hammer. And then the second one would have been here on a 3-bar play, that little red bar after this green momentum type move. So let me talk you through both entries. And I think this is just useful to do so you can understand like how I look at charts and how, that one step further from just the pre-market prep and whatnot. So this red hammer candle is super interesting because before it, notice that we had 2 inverted hammers right here. And we even had this one. And there is like the sellers, they broke the low and they got some follow through. But here, we didn't break these lows, right? So when this hammer candle forms, you have to imagine, right? At one point, it was one solid red bodied bar. It broke both of the lows of the inverted hammers and it went right to this low. So sellers, like, if they were going to make something happen, that was the time to do it. Get the flush of this flag, push us back down to the open and whatever, we'll go from there. But the fact that this turned into a hammer, the fact that we broke these lows, sellers were not able to materialize, and we closed back at the, like, literally the top of this little range here. You can think of this as like a micro range. We closed at the top of that. I'm thinking again, like sellers, they failed here. They failed here. This is a hammer candle. So we know, right, based on what I was saying earlier, we can put a stop loss underneath this low. We can get involved on the break of the high. And what's our hourly target? Like way up here at 45th, like way up here. So if we're going to risk this to make this reward, that makes sense every day of the week. You know what I'm saying? I don't even know what that is. Maybe a 5? 1, 2, 3, 4, like 4.5, maybe. I don't know. Maybe I'm being a little bit aggressive there, but 4 to 1, we'll call it, just for the sake of the example. That's a really solid trade. So that's entry number 1, right? Long here, stop underneath the low. Sellers have not proven themselves once. They've failed once again. Time to take advantage of that. We know we're getting bull flag consolidation. We know that at this point, so here's the 10:30. Yeah, we're not quite on the hourly bar close. Obviously, that would be 11:30 here. But we can get the sense that the hourly bar certainly it's not breaking down aggressively. That's for sure. So that's entry number 1 that you could have spotted based on this hammer structure right here. That's why the hammer is so important. Now, you could also say something like, well, Matt, why weren't you looking for shorts underneath the low here, underneath the low here? It's because the context of the hourly chart and the failure from the sellers already underneath the lows, I wouldn't really want to position short, right? Sellers already failed once. I don't want to be involved on a second failure, and that was ultimately the right choice. Now, let me also be very clear. If the market did something like this, and started breaking down, it just would have been a missed trade, right? I mean, it's I'm not going to sit here and tell you that, oh yeah, we're going to catch every single trade, every single move in the market. Just it doesn't happen that way. The context of the day, because we got the gap up, bullish, because the sellers failed underneath the low of the morning. To me, it's a failure from the sellers, so that's also a bullish sign. And we're just looking for the bull-sided trades, aka hammer candles. So that's that entry. The next entry I said was right here on the 3-bar play. So we get a successful breakout of the flag, right? Momentum is clearly in the upward direction, and we're also getting confirmation of the break at the top of the range here and the hourly high. So again, there's actually a couple entries here. You could look at this hammer candle entry and say long over the top, look for that run. You could say this is a 3-bar play up here, right? Long over the top, stop under the low. You would have gotten stopped out after a little pop, but generally just looking for any excuse to get involved in the upside with tight risk. That's the key. So this first red inverted hammer provides an inside bar in the upper 50% mark of this green bar's range after a momentum move in the upward direction. So you've got to think, okay, bullish consolidation is taking place. If I can place a stop under this low, get involved on a break of the high, good to go. So that's kind of exactly what you could have done. Break of the high, you're in here. So now the trade looks something like this, right? There's kind of that's your risk. And then your reward would have been, again, up towards this hourly top, around 40.50. So, whatever, something that looks like this. And now that's actually an even, maybe my eyes are doing me wrong. Yeah, that's even better. That's got to be better. That's an even better risk reward ratio because the stop is so much tighter, right? Compared to this stop here, that risk size.
Yeah.
So generally just using the candle structure as the thing that defines the risk and thinking about the psychology of like who's hurt, who's feeling good, those types of things is really important. And like even into the close here, I mean, Friday was a really, really great day. So many different entries. If like look at this red hammer candle, right? You could look at this green one as well and say, okay, well, you know what? This green one actually doesn't, to me, it's not as interesting. Why is this red one interesting? Couple of reasons. That's the main reason, right? We're coming into this series of lower highs on the 5-minute, nothing crazy on the hourly. We're not like flipping into a downtrend aggressively, but we've got lower highs and we've got this established set of lows. What again? Who failed here?
Sellers or
yeah,
they couldn't down anymore.
Absolutely. Sellers absolutely failed. I mean, they're at one point in time, remember that this red bar was a solid red bodied bar. And the sellers were like, oh yeah, this is great. We're breaking this thing down. We're coming off of lower highs. But by the time the 5-minute chart closed, right, where are we? We're back inside of the range. We're above the breakdown level. So sellers, still no momentum. Nothing good going on. So long over the top, stop under the low. I mean, again, 40.50 up there. Great. Risk reward. Perfect. Right? Here's about the cleanest 3-bar play I think I could ever show. Right? That's actually, I guess you could call it a 4, right? 1, 2, 3, and then 4 breaks the top, stop under low. So if this is your risk, your reward wants to be up towards that 40.50 area. There's another one. So Friday, and like let's not fool ourselves. Friday was a rare day. You get that maybe like once a month, right? Where there's just, straight momentum in one direction all day. Market doesn't stop. That's very, very rare, but it does, just for example's sake, it offers up some really clean examples of price action and, the thinking behind like what the particular entry was. So that's how I look at the market. That's how I use these charts in conjunction. And to me, at the end of the day, the price action knows all, right? The price action it has all the information we need, and everything else outside of price is just usually it's a mathematical formula based on price. So to me, why wouldn't I look at the most pure interpretation, the candles, instead of like an indicator or something like that? I think that the story of the candlesticks is more powerful. That's my take, right? So you don't have to I like to tell people this after I go through my spiel. You know, you could take a piece of what I've just said and apply it to your strategy. You could take none of what I just said and say, you know what, Matt, it's great talking to you, dude, but this is not for me. You could take all of it and say, I'm going to
Yeah.
apply all of this. It sounds great. So I'd love to, what are your thoughts? Do you have any questions, initial reactions?